In this video, we will talk about the Federal Reserve System as it pertains to the monetary policy. Now, Fed is often a very confusing structure. We don't know what the Federal Reserve System is, and there's a lot of misinformation about the role that the Federal Reserve Bank does. So before we look into monetary policy, let's unpack the structure of the Federal Reserve System. The Federal Reserve is a central bank of the US economy. It is called the banker's bank because it deals with the monetary policy and it also deals with the various other commercial banks in the US economy. At the helm, the Federal Reserve System is the public as well as the private side of the US Federal Reserve Bank. The three key entities are the Federal Reserve Board of Governors. These are the public side of US, the Federal Reserve System. The Board of Governors appointed by the President and confirmed by the Senate. Then we have 12 Federal Reserve banks. And finally, the Federal Open Market Committee, which is the entity which decides on monetary policy. The Fed serves 5 key functions. The first function that the Fed serves, and that's what we'll focus on in this presentation, is conducting monetary policy. But the Fed also helps maintaining the stability of the US financial system. And since the Great Recession, another role that has become prominent by the Fed is supervision and regulation of the financial institutions. Then there are 2 other services that the Fed provides. It provides fostering of the payment system by clearing of checks, etc., and also promotes consumer protection and consumer community development. So the private side of the federal system is the Federal Reserve banks. US is divided into 12 districts, where each district has a Federal Reserve System in charge of those districts. Minneapolis comes in District 9, and the Federal Reserve Bank in Minneapolis is in charge of monetary policy in the upper Midwest. So let's move on to the monetary policy. Monetary policy typically is the control of money supply by the Federal Reserve Bank. There are 3 tools that the Federal Reserve Bank uses to regulate money supply. The first tool is the open market operations. The second tool is reserve requirements. And the third tool is discount window. Now, since the past 20 years, the Federal Reserve has also been engaging in some non-traditional tools of monetary policy, especially in light of the Great Recession. The fourth tool that the Fed has been using is forward guidance. In forward guidance, the Fed indicates what they expect interest rates to be, and this is often looked by the news media and businesses to make their future decisions. And then off late, the Fed has been engaging in large purchases of assets to shore up the financial markets. So the last 2 are more non-traditional. In this video, we'll focus on the first 3, the traditional monetary policy. Now, why does the Fed do the monetary policy? The Federal Reserve has had a mandate by the Congress to ensure that there is employment as well as there is price stability. And the Fed also is in charge of ensuring that there's moderate long-term interest rates which stay stable. The 3 tools that the Fed uses for monetary policy are open market operations, which is essentially buying and selling of government bonds. So if the Fed wants to increase the money supply, the Fed will start buying US bonds. When they buy these bonds, they pay with cash, which goes to the US monetary system. Then the US banks have more money, which they can loan, and as a result, interest rates will be decreasing. The money supply goes up. On the other hand, to reduce money supply, the Fed will sell government bonds. There's always a demand for government bonds, and when the Fed sells the government bonds, they're taking money inside from the banking system. As a result, there's less money supply available. So the open market operations are the purchase and sale of US government bonds by the Fed. This is done through the New York Fed's trading desk, and it's fairly easy to control, so the Fed uses this as its choice of monetary policy tool. The second tool that the Fed uses is reserve requirements. All commercial banks are required to hold certain reserves in the Fed vaults as a safeguard against bank runs. This reserve requirement affects how much money gets created in the US economy. To increase the money supply, the Federal Reserve can lower the reserve requirement. As a result, banks have more money on their vaults, which they can loan out, and money supply increases. On the other hand, to reduce money supply, the Fed will increase reserve requirement. As a result, banks have less money to loan out and the money supply decreases. The third tool that the Fed uses to increase money supply is the discount rate. Discount rate is the rate that the Federal Reserve charges other commercial banks for short-term loans. Sometimes these banks may run lower on reserves, so they may approach the Federal Reserve Bank to borrow from it. Discount rate is the rate that the Fed charges these commercial banks. To increase the money supply, the Fed may lower the discount rate. This will encourage banks to borrow more money from the Fed, and they'll have then more reserves to give out as loans. On the other hand, to reduce the money supply, the Fed can increase the interest rate that it charges these banks. This will discourage banks from borrowing from the Fed, and the banks then have less money to loan out. So the discount rate is often used to provide extra liquidity to the commercial banks. And this was a tool of choice, especially after the great meltdown we had in 2006, 2008. Now, all these three tools target what we call the federal funds rate. The federal funds rate is the rate that commercial banks charge each other in short-term markets. On any given day, some banks may have excess reserves, and some banks may have insufficient reserves that they need to give out to their depositors. So when banks borrow from each other, the interest rate that they charge is called the federal funds rate. And it is this rate that pins down all the rates in the US economy. And the federal funds rate is the target of the three tools that we saw before. The FOMC, or the Federal Open Markets Committee, uses its monetary policy to target the federal funds rate. So the federal funds rate in the US economy is the most important rate because that rate pins down all of the rates, and it is the rate that is the target of monetary policy. So let's summarize this in a schematic. What we see is that the Fed uses three tools: open market operations, discount rate, and the reserve requirement. Of these three, the tool of choice is the open market operations. All these three tools are targeting the rate that commercial banks charge each other, and that rate is called the federal funds rate. In the US economy, it is this interest rate that pins down all other interest rates. The mortgage rate, the credit card rate, the car loan rate, etc. All the rates are pinned down by the federal funds rate, and the federal funds rate is the target of the Fed's monetary policy. So if the economy is in a recessionary period, it needs to be stimulated, the Fed may use its tools to lower the federal funds rate, which lowers the interest rates. As interest rates are lowered, firms may invest more, consumers may spend more, they may borrow more. As a result, the US economy gets stimulated. On the other hand, if the economy is overheating, the Fed may want to temper the economy down. In that case, they may use their tools to increase the federal funds rate, which in turn increases the other interest rates. This will act like a deflationary pressure. It might lower inflation and lower overheating of the economy. So all in all, the Fed uses its three tools and targets the federal funds rate to work towards its mandate of keeping unemployment low, keeping prices stable, and having a moderate long-term interest rate.